podcast. It's great to have the opportunity every day to welcome back our prestigious and very capable podcast commentators from across the world. And we're really grateful to have them for another season. Let's kick off, given the news of the day that I just picked up on before we came on air with Neil Atkinson, former head of oil markets at the International Energy Agency. The Financial Times' lead story right now is that Fatih Birol's op-ed in the FT newspaper today calling for peak oil demand, peak oil and gas and coal demand will be earlier than expected. It's going to be the headline of the World Energy Outlook, which is published next month. But as a curtain raiser, Neil, he's put an op-ed in the FT today that says peak oil, coal and the gas demand will be coming earlier than usual before 2030 and then decline. I just wanted to get everybody's reaction to that. Obviously, yours first.
Yeah, sure. Thank you, Sean. I've got the article up on another screen right next to me here. I must say I'm a skeptic that is likely to come about, simply because if you look at the likely trends in demand in developing countries. Let's not forget that we saw peak oil demand in OECD countries back in 2005 or 2006, something like that. And I think we saw the same for coal back then as well. So we've been here before as far as the OECD countries are concerned. But all the action now and for many years to come is in developing countries, which have energy use per capita significantly below that of the Western countries. And those growth pressures from rising incomes in developing countries, rising populations in those developing countries over the next decades suggest to me that unless by some miracle, developing countries can grow their energy infrastructure almost entirely in climate-friendly ways, they are still going to use a lot of fossil fuels in transportation, the petrochemical sector, for consumer goods, and so on and so forth. So I'm skeptical that the peak will come as soon as the IEA suggests, but we'll obviously have to wait and see. And just one quick final point here. This has been an article published today in the FT. It'll be very interesting to see what happens tomorrow when the IEA publishes its monthly oil market outlook. Now, that's what I call a message from the real world, not a scenario to 2050. And it'll be interesting to see if, for example, the IEA oil market report contains an upgrade to current levels of oil demand growth and possibly through 24. Because the further into this decade you get with relatively strong oil demand growth, the less likely it is that the peak is going to happen in 2030 or just before.
Let's go to Muscat with Ali Al-Riyami, consultant and former Director General of Marketing, Ministry of Energy and Minerals in Oman. Ali, the reason I bring this up, obviously, because it is a notable statement from the world's main multilateral agency, historically representing consuming countries. But Ali, the impact of this narrative, which is somewhat ongoing now, that the sort of end of the oil era, or the beginning of the end, as Fatih Birol describes it in the FT today, does compel oil producers like Oman and Saudi Arabia and all the others to accelerate their production, to maximize revenues now, and so influences policy now, even though, as Neil points out, we're talking sort of the end destination being 2050 or beyond. But the narrative now does compel accelerated value maximizing now. Your thoughts on that?
Well, first of all, thank you very much, Sean, and it's always nice to be back, and I hope this new season will be better than last one, and looking forward to participate with you again and again. First of all, I think these countries, if they believe, I don't think that these countries, they believe on this kind of reports, and I don't think that the peak will be in 2030. So I don't think that there is anything of these countries that to do faster or to produce more and to maximize the revenues out of oil, because I don't think that they believe that, the peak, it will be 2030. There will be a need and demand for oil for the coming maybe 20 to 30 years coming. So there is some projects. We know that everybody knows that there was a delay on so many projects, upstream projects, because of COVID, because of other, financial issues that everybody faced before. But these projects, we are going to see coming on the stream very soon, 2027, 2028 and onwards. So it doesn't mean that, the countries, they want to maximize. It's just to keep, the world, to keep the energy for the world enough for everybody to use, actually. And this is the mindset of the countries like Saudi Arabia, like Iraq, like Kuwait, the producers, the big producers of oil and fossil energy. So I'm a bit worried when I hear this kind of messages from respectable organizations like IEA talking about the peak in 2030.
And then the Financial Times puts it on the front page. So I mean, it is a dominant. The Financial Times being
you need to debate with them and to ask them what is next. I mean, what do you think? What will happen after 2030?
Well, he's saying the accelerate.
Peak, and then we start seeing some productions going down, or the demand of the world going down. I mean, I don't think so, because the need of the energy will continue to grow as long as there is human beings in this world, either fossil or energy or renewables or hydrogen, you name it. But this kind of political direction that we have been driven in, I mean, I don't really agree with that.
Vanda Nahari, founder and CEO of Vanda Insights. Welcome your thoughts on that, Vanda. Obviously, you're just talking in the green room about the narratives from APEC week last week in Singapore, when all of the market end of the industry got together, and whether this is featured. I certainly spoke to, we've had a few of the team on the podcast this week saying that there was a very robust view from producers that they were going to hold the line on cuts to maximize oil revenue at this time. Ultimately, this IEA type narrative is not new. The peak narrative is not new, and it has triggered, I would think, generally a more robust attitude from OPEC and OPEC Plus that we've seen in recent years. We're going to serve our own interests now, not the collective interest. Your thoughts on the op-ed in the FT today, and welcome some of your insights from APEC last week.
Yeah, Sean, well, you've already summed it up quite nicely yourself. I
wasn't even there.
I do wonder if this is, as you mentioned quite rightly, this is not new. We've heard this before. But as, I do wonder if it's in response to the price rally of recent days and weeks. I wonder if it is a response to the deeper cuts by Saudi Arabia and the OPEC Plus cuts. And I fully concur with my two fellow speakers here that it is dangerous. I'm smiling, I don't want to, because I seriously mean it. This is sending signals, as much as we continue to hear from the OPEC Plus members that they believe oil and gas will remain very much in demand for a few decades. We do see a sort of urgency in these countries to leave as little of their resources as possible, what we call stranded resources, to use as much as possible, but at the same time also to maximize the revenue they're getting for as long as they're getting it. So I was just scanning the first few paragraphs of this article that you mentioned in the FT. Look, if Mr. Birol had said that perhaps coal is going to be peaking this decade, I would have perhaps, swallowed it. But to say that coal, natural gas, and oil will all peak in the next 7 years, I'm sorry. And nobody in the room or in the discussions last week in APEC would have believed either. The other theme, just going back to last week, was, of course, the huge uncertainty and unpredictability that is now sown into the markets. Last year was understandable because of the Ukraine invasion and all the disruption and feared disruption of a Russian supply. But now it is, on the one hand, China, the uncertainty over how Chinese economic recovery and oil demand will pan out. And on the other, the tightening of the mark of supply by OPEC plus. I personally think, just very quickly to round this off, Saudi Arabia, and this has been perhaps for me at least the most surprising element of the market so far this year compared to where we were at the beginning. Saudi Arabia has just changed the market calculus completely. I think nobody had foreseen that they would take such a hawkish turn in strategy.
Neil, the outlook of the last week, as we've seen the Saudis announce the extension of their unilateral voluntary 1 million barrel a day cut beyond the OPEC plus cut, which was already of scale, was enough to trigger Brent above $90 last week, and it is now holding in that position. Today, we are touching on $91 on Brent. Your thoughts on the dynamic of supply and demand in the current market, pushing the pressures up on the front month for Brent. Is this a supply story, restricted tightness, or is there still a sort of demand in the old dog yet?
Well, there's still life in the old dog, that's for sure. I think your survey question should have had yes, no, and maybe. But fair enough. It's not a criticism. It's a combination, isn't it? Because there is still uncertainty about how strong demand growth is, although it is now pretty certain, as we're already well into the second half of the year for data, that demand growth is going to be fairly strong. But it could be perhaps in the end even stronger than we currently think. Nobody really knows, because the macroeconomic pressures from potentially more interest rate increases, the ongoing woes in China and its property sector and in other parts of their economy. And then on the other side, you've got the OPEC plus supply cuts, which you've mentioned. Now, OPEC plus in a way has done us all a favor by, instead of leaving us hanging every single month, waiting to see if they're going to extend it by another month, they've gone the full deal and told us it's going to stay in place until the end of the year. If that is indeed the case, then it's difficult to see how oil prices could slide back significantly from where they are now, that's for sure. But on the other hand, it's also, I think, difficult to see prices soaring significantly higher than they are. So I'm in the sort of in betwixt and between camp with, I would have voted for maybe, with a tendency towards feeling that prices are perhaps likely to settle around this high 80s, $90 a barrel where we are now.
Ali, how do you think OPEC plus, Oman, obviously at the forefront, particularly in the context of China demand, it remains very robust despite the headlines about the weak recovery from China coming out of COVID. We saw last month in August the data, the record level imports of oil into China, Ali. So even with the headlines and the general narrative of weak outlook for the Chinese economy, imports remain rather strong. Which of those two should OPEC plus be guided by in its forward policy, do you think?
I think, someone has to ask why China, they're still buying at this kind of situation. Why they still, although that we see some signals from China that the economy is not growing, they are facing some difficulties on the housing sector and also in the industry sectors. And still, we see that the demand of oil for China is tremendous. So I think although that we have also another signal from China, which is the numbers of electrical cars that they have already in the market at the moment is just growing. So
and exporting.
And they're exporting, yes. But the answer for this, I think, it is more to do with inventories and also storage, rather than using it at the moment, using it now, because I don't see where the products or the refineries will be able to to refine all of this oil and also to get a margin out of this. I mean, the whole thing, nobody is touching about this. Nobody is asking where this oil is going to, why China is still buying. I mean, I don't know the answer, basically. Yeah. So I hope that somebody can answer me and say, there is something happening in China and nobody's seeing it. But so far, I don't know why they're still buying, why the economy is not doing very well. The world economy is not really growing as much as everybody was expecting. So basically, we will have to wait and see until end of this year and start at the beginning of next year.
Or we all have to read Vanda Insights, because that's where all of the information is in terms of the why, the answer to the why, Vanda. Tell us why, Vanda, China is, what's happening in this gap, if you like, between the macroeco and yet imports remain very strong. They are, of course, exporting a lot of products now into Asia.
Yeah, and there was quite a bit. I mean, China, what's happening in China in terms of macroeconomic data and the divergence, if you will, also between macroeconomic data when it comes to factory activity, PMIs, and exports, and you see oil imports on the other hand. That was it dominated conversations in APEC. This year, for the first time, we had the advantage of having Chinese delegates back in Singapore for APEC. If you remember, in 2022 APEC, China was still under very strict zero COVID lockdown. So it was good to get some insights from those delegates as well. And look, here's the sort of big picture. So yes, Chinese crude imports have been strong. Partly the numbers have also been strong because China has had access to not two, but three sources of heavily discounted crude. So in addition to Venezuela and Iranian barrels, there's also been Russian discounted barrels. There is a sense that China has probably been stockpiling a bit with the assumption that prices might be higher in the second half, certainly in the fourth quarter of this year. And so far, it seems like that was a good calculation on the part of Beijing. So if you look at the first 7 months, yes, imports have been quite strong, double-digit growth, but it looks like China probably salted away close to 900,000 barrels per day, has moved into commercial inventories in terms of crude. Refining runs have been pretty high in China. Refining margins have been good. So that's been true in the independent sector, the so-called teapot sector, as well as the state sector. But then, yes, domestic demand has grown. Domestic demand of gasoline has been strong. And I think, as we heard from Victor Yang yesterday on your show as well, jet fuel is climbing. Jet fuel is expected to climb much more in the coming months, as China's international routes had so far been restored to only about 50% of where they were in 2019. But especially the China-US routes are being restored very quickly now in the coming months. Diesel is very interesting. So diesel demand used to be mostly in construction and industry. Of course, that has not recovered, but it has shifted to road transport, to goods transport, because e-commerce has just boomed in China during COVID, and that trend continues. So overall, that's the picture. China is exporting more refined products, exactly as you say. So I was just crunching some numbers earlier. Chinese refined product exports on average have gone just above 1 million barrels per day in the first 7 months of this year, compared to about 700,000 barrels per day average through 2022. So it's a mix of all. In the coming months, again, what Victor Yang was saying yesterday, that's what I heard this week from other participants during APEC as well, that most likely China will destock as prices are higher in the overseas markets, and it has now got a good stockpile of crude. So we expect crude import perhaps to continue to be high year on year, but the growth is not going to be as strong, not in double digits in the coming months.
Let's go to the survey question, which is obviously touching on this subject that we kicked off with. IEA Director Fadi Birol has forecast in an op-ed in the FT today that demand for oil, natural gas, and coal will peak before 2030. Do you agree or disagree with him that it will peak? That demand will peak before 2030. Agree or disagree? Big bum. Neil, we also had, I mean, and as on this narrative in the weekend just passed in Paris, the French energy transition minister Agnès Pannier-Runacher, which I completely probably destroyed her name, but nonetheless, she told French radio program that if oil companies don't transform, they will not have no chance of survival. That's a curtain raiser, perhaps, to Fatih Birol's comments today in the FT. But just a culmination of these things, I'm alert not to the big wheel of time that they all refer to, but to the immediate dynamic that it has on relationships. We've seen the IEA and Fatih Birol, who was a regular visitor and attendee to many energy and oil conferences here in the Gulf for years, has been sort of persona non grata recently. And clearly there is a split there, not a lot of love lost in the current climate between the major players of OPEC, OPEC Plus, and the IEA. I'm wondering what your thoughts on that are. Is there consequences of that? Does that matter? Your insights?
Well, I'm not sure it matters that much. There is no doubt whatsoever that there is a chilly relationship these days between the IEA and OPEC. For example, I know that personally. And been less visibility on the part of the IEA at some of the big oil-dominated conferences that we're used to over the years. But the IEA is it's an advisory shop. It's there to advise its member governments, 30 odd of them, whatever the number is now. It doesn't produce any oil. It doesn't own an oil refinery. It doesn't have a wind farm. It's there to advise. And it's, whatever the criticisms we may make about some of the conclusions that the IEA draws, it does do a vital public service in producing vast amounts of data and insight, which is not available in huge quantities in many other places. So it's performing a service. And in fact, the fact that we're giving so much attention to this morning demonstrates that it has a very prominent role. So, it's not going to, the IEA.
I mean, one of the sort of general narratives from the oil producers or the hydrocarbon producers is the need for an orderly transition, that Sultan Al Jaber, who is the head of ADNOC and also has a prominent role in COP this year, his whole communication to all stakeholders is, yes, this transition, this outlook for the climate is real and challenged, but we need an orderly, coordinated one in which we all cooperate and are on the same team. The likes of today's op-ed will make that more difficult, one would think. And if we don't have cooperation, then there's challenge.
Well, I think this concept of an orderly energy transition is for the birds. There are far too many players out there and countries out there. There's so much going on. So the idea of some kind of grand, centrally planned transition over the period to 2050 is nonsense. My ongoing narrative, which I had a brain fade earlier in our meeting this morning, where I was about energy use per capita, very simple. Even after 30 years of economic development, China only uses 65% of the energy per capita that the OECD does. In India, it's only 15%. And in Africa, it's only 8%. Now, you tell me that those other countries and other regions can grow their energy sectors over the next 20, 30 years without continuing to use massive amounts of fossil fuels. I just don't believe you.
It's certainly every percentage point that they go up and that the OECD don't go down is certainly a very large amount of energy consumption. Ali, looking forward into obviously the fourth quarter, the oil price and the tightness in the market looks rather, consolidating above 90, and the outlook looks, bullish. Your thoughts looking forward to the end of the year? For that tightness to continue, that backwardation in the market to hold?
I think the backwardation will continue to the end of this year, and that is the intention of OPEC and also all these cuts that we see from different countries, Saudi Arabia and Russia, and also from OPEC Plus. So I think the backwardation will continue. I was really surprised at the beginning of this year to hear some, agencies and also some consultants talking about 110 and 120 dollars per barrel towards the fourth quarter of this year. There was no fundamentals to support that that time at the beginning of this year. So I don't think that we will end the year with the same kind of imagination. I think the price will be between 90 to 91, 92 maximum towards this end of this year. Because of the reasons that we have been talking about from the beginning of 3 months now. From the last 3 months, we've been talking about, we don't see any growth in China. We don't see any demand, although that the demand is tightening up now because of the cuts and extra cuts that we have seen. But still, we have to consider also the growth, the world economic growth. It is not really there. Otherwise, the Saudis and the Russians and OPEC in particular, I don't think that they will allow the world to get into a too much tight, oil demand unless they see that there is a good reason for that. And people will talk about, price, after price and so on and so forth. But that is not really a good reason. 80 or 75 or even 85 is a very sexy number for the Gulf region here. But so to tell us or somebody to tell us that OPEC or OPEC Plus they're after price and pricing issue, I don't think that could be the correct answer. But again, we have to be cautious, and we need to focus on the market and to react, accordingly. I like the idea that was to monitor the market on a month-on-month basis. But unfortunately, surprised us, the Saudi Arabians, they have surprised us that they have taken a decision that to continue the cuts until the end of this year. Maybe they have a reason for that, but let's wait and see what's going to be the result of that towards end of this year.
Vandana, just to wrap up, obviously with the survey result coming out, the weakness, there's a big disagreement in this room. Obviously, we'll post that on social. But looking at the rest of Asia, where the marginal demand growth has been for many, many years, and whether we're seeing now serious economic challenge in Korea and Vietnam, manufacturing slowing down quite substantially, while India does remain the sort of outlier. Where does the outlook for Asia go into the fourth quarter from an economic growth and hence energy demand point of view?
Yeah, so one of the interesting dynamics in this region to keep an eye on is the effect that Chinese economic momentum has on the rest of Southeast Asia. Now, of course, aside from China and India, we all know that Southeast Asia is the fastest growing economies and fast growing oil demand as well, from a relatively low base, but nonetheless a major growth center. And it's starting to become apparent now China's struggle to regain economic momentum is now casting a shadow on Southeast Asian economies as well, which shouldn't be a surprise. And these economies will continue to struggle as long as Chinese economy struggles as well. Frankly, I don't see light at the end of the tunnel for China. Well, at least well into next year. So, there's.
Have we reached the bottom there yet, do you think, or is there more economic downside?
Good question. I think that was asked quite a bit last week as well. The view from China experts and delegates from China was the answer to that question was yes, that it is past the worst of the economic cycle. I personally think let's wait and watch. As I was about to say, there's going to be no big bang stimulus. So there's no silver bullet this time that Beijing has. So that's the scene from.
Do they have it and they just don't want to use it, or it's not there?
They do not want to use it, Sean, because debt, especially provincial level debt, is already a huge worry for Beijing. They do not want to add more to that debt. And the next point, which is that they do not want to create more overcapacity, whether it's in the real estate sector or it's in the industrial sector. This has been true pre-COVID even. So those are some of the sort of big tenets of that Beijing lives by, which are not changing and which have now become major hurdles in terms of it being able to just kind of do a big bang sort of stimulus in the economy. That's not going to happen. So it's going to be a very, very slow recovery. That's the overall scene. I would just quickly close with the comments that I think, and as Ali was saying as well, is that we started the year with demand worries, and we are sliding into the fourth quarter with supply worries. So the single one major factor that has changed quite dramatically is OPEC plus cuts, but within that, I would say the additional Saudi cuts. So I don't see a major, I really can't see what would pull down prices significantly from where we are now. But at the same time, I don't see them going a major runway beyond 90 either for crude.
Well, we will have to wrap it up there with Brent trading just knocking on $91 a barrel this morning in early Asian trade. Neil Atkinson in Paris, thank you so much for joining us. Vandana Hari in Singapore and Ali Al-Rayami in Muscat. Thank you guys very much for joining us today. We'll catch up every morning, 10:30 UAE time. All the best.
Thank you. Bye.
Thank
Cheers.
you.
Okay, bye-bye.